Is it live?
You are live now, ma'am.
Okay, great. Good evening, everyone. So, this week it's a second session of WOS Finance Program, Naari, Nayan Nivesh. Thank you for your wonderful support for the previous program. It was an introduction to personal finance. Now we graduate to the second level, that is that emergency fund and also the bonds, fixed income assets. After that, you have an exposure to the intricacies of mutual funds. We have great speakers today, Dr. Shraddha Sureka and Dr. Pashyanti, for detailing on that aspects. As an introduction, let me introduce our leads. Let me share the slides. So, Dr. Mohita, she is the person behind the program and she does not need any introduction. She is an inspiring leader. She is also the visionary leader behind this. She is the founder and chairperson of Tirupati Eye Center and Research Institute at Noida. We all need no introduction to her. She is the Joint Secretary at AOS. She is also General Secretary of Women Ophthalmologists Society, Women Ophthalmologists Worldwide Network, and UP State Ophthalmological Society. She is a global academic icon. She is also a recipient of prestigious honors, WIO Honorary Awards at San Diego, Champion of Change Award at WOC Spain, Dr. B.C. Roy Award, Wonder Woman Award. These are all few of the many awards that she has been receiving. And coming to Dr. Shraddha Sureka, she is the lead, co-lead along with me in this program. And she is also the speaker for the session today. And she did her fellowship in cornea and anterior segment from the prestigious Institute of L.V. Prasad Eye Institute. She is the founder of Centra Hospital, Malad, Mumbai. She has special interest in dry eye disease, cornea transplant, and ocular surface surgeries. She is also the honorary cornea surgeon at Grand Government Medical College, Mumbai. She is very passionate about personal finance and advancing women's financial literacy, and that's the reason why she is actively participating in this. Dr. Pashyanti also has her fellowship in glaucoma from the prestigious Institute of L.V. Prasad. And she did her, in addition to the fellowship that she has, she is also trained in personal finance from the educational platform Wellcon. She had finished her trade vesting mentorship program and she has interest and passion in the field of finance. And she is very well known in the field of finance education, at least among women ophthalmologists and the ophthalmologist in AP. Coming to Dr. Thomas George, he's my very senior person. I have a lot of respect to him. He's a senior consultant in glaucoma and cataract services in Kerala. He works in Chaitanya Eye Hospital and Research Institute in Trivandrum. He has held a lot of positions in Kerala as website editor, joint secretary, and treasurer in KSOS. His contributions were also in Trivandrum Ophthalmic Society as secretary and president, and we have in women so many common interests, like he again glaucoma and finance. Again, nature is his area of interest. Thank you for joining us, sir. Dr. Meenakshi Nitin Pagali, she's also like amongst youngsters, she's also known to be Dr. Ridhima's mother. Her designation is she is the director at Medilasers Private Limited. She has affiliation at Nayan Eye Clinic and Medilaser. She is again interested in cornea refractive procedures and cataract. She has been president and trustee of Pune Ophthalmological Society. She's a member of Maharashtra Ophthalmological Society. CM, her areas and contributions have been conducting CMEs for education of refractive surgeries. She has also experience as working as sub-broker in Pune Stock Exchange. Her hobbies include painting, traveling, and again, finance. Finance is what links us together. Dr. Neelam Kaur is a senior consultant ophthalmologist doing private practice in Delhi. She has her financial journey credits given to mentors of financial journey from her mother to Miss Rashi Bhargava and Dr. Akash Patel. He's a prominent retina specialist from Rajkot who runs investing coach for doctors. Thank you, madam, for joining. And we
Thank
have
you.
also Dr. Raj Shah. He is again director at Shah Eye Care Center, which is in West Mumbai. He is interested in cataract, LASIK, and squint surgeries. Thank you, sir, for joining. Again, my own friend, Dr. Raghi. She's a consultant phaco surgeon from Chaitanya Eye Hospital, Kollam. She's an AOC executive, Young Ophthalmology Society of India executive. She's again an executive of Young Women Ophthalmological Society executive. She has many papers to her credit. She is a speaker in state, national, and international platform. Her interest is in cataract and medical retina. Thank you, Raki, for joining us. And without uh, much delay, we will go on to the topics. And first, Dr. Shraddha will take us through emergency fund and fixed income assets. So last time in the personal finance topic, we have told the importance of emergency fund. Let's hear from her.
Ma'am, before we start, first of all, thank you for the introduction. I'd like to introduce you too. So, Dr. Jayashree has done MBBS and MS from Kerala, and she is now a consultant glaucoma specialist in Kerala. She has been at the forefront of the Women's Ophthalmology Society India in financial education series for the past few years, and she's doing a great job at getting everything in place for educating women and others and doctors for uh, personal finance related topics. So thank you, Dr. Jayashree.
It's
And
kind of you.
without further ado, I'd like to start with the topic for today. So,
Just a minute, Dr.
yeah,
Mohita, she is not doing so well today. So
right,
as if she's comfortable, she might join in between. So we'll hope she is able to do that.
right. So, uh, is my screen visible?
Yeah, I mean slideshow. Yeah.
Yeah. Okay. So, I'd like to start the presentation firstly by stating that I don't have any financial qualification. This is just personal discipline and something that I am interested in, and something that I feel very deeply for, considering that it has given me a lot of, you know, uh, sense of stability in unstable times, a lot of psychological uh, stability, that, at least one thing is there which works. So, let me start off with some scenarios which have happened in real life. So, 2008, the credit markets froze all over the world, and 170 billion US dollars fled the money market in just 2 days. So, companies couldn't pay employees. The credit markets froze overnight. There were massive job losses, and government had to come in and give bailouts for multiple things. So it was like a great recession. uh, the next wave came in during COVID. So COVID hit us, and in March 2020, the market crashed. Incomes crashes overnight. Your EMI payments, school fees, rent, staff salaries don't stop. In America, 33% of people had no emergency savings when that pandemic hit. And in India, the numbers were even worse. So families had to borrow from relatives, They maxed out their credit cards and they fell into huge debt spirals. So to come out of that, it uh, took a long time. Some people are still grappling under the effects of that. Now, this thing we think happens only to poor people or only to people like us. But if we look at these examples, Mike Tyson earned 300 plus $1 million, but in 2003 he filed for bankruptcy. He had zero emergency reserves, and this lifestyle inflation destroyed him. Nicolas Cage, again a Hollywood superstar, a huge fortune, but nearly bankrupt in 2009. There was no liquidity when he needed it most. Amitabh Bachchan, he hit near bankruptcy in 1999 2000 and probably didn't have liquid reserves during his business failure. So, this pattern is quite universal that bad things happen. Your financial situation kind of can collapse. Practically, if we see, if there is a hospitalization and a big medical thing happening, say amongst you or your close family members, there would be a big bill which comes up. And Zerodha's Nitin Kamath has uh, quoted that most Indians are probably one hospitalization away from bankruptcy. So when that emergency situation arises, you may suddenly all your savings may just go away. So let's take the example of Warren Buffett. He's sitting on huge amounts of cash. It's not because he's scared to invest. This guy doesn't need to be scared to invest. He's prepared. So in the 2008 crisis, what he did was he had again massive cash reserves. He bought companies which were at that time valued at a lower price. And then when the market came up again, the investment yielded very good returns to him. So even now with the uncertain times, it's said that he's holding on to huge amounts of cash or liquid assets. So with that, we kind of get an idea about why an emergency fund is required, and it needs to be separately designated from other things. So an emergency fund is kept for genuine emergencies like a job loss, medical crisis, major repairs. It's not because your new iPhone has come out in the market. It's not because your neighbor is going on a holiday or some EMIs. So rent and what all will come under essentials here: rent, your grocery, basic food, utilities, electricity, water supply, internet, insurance premiums, which we often forget while calculating, loan EMIs. So once we know that, okay, we need to have an emergency fund, the next question is how much. So for salaried employees, you can keep 3 to 6 months of your essential expenses. But for self-employed people or freelancers, they probably require a larger chunk, 6 to 12 months of essential expenses. And single income family, which may not have a lot of backing, not too much assets, may actually want to touch the 12-month mark of their essential expense. Now, if you take the example of an Indian doctor, if your monthly expense is 1 lakh, your target emergency fund should be 6 to 12 lakhs. And where would you park this emergency fund? You would keep it in a place which is safe, wherein your capital is protected. You cannot afford to lose this money. It should be liquid. That means you should be able to access it within 24 to 48 hours, and it should be low risk, so that there's no chance that it will kind of market crashes and it goes away. So the best thing is that you put it in a high yield savings account. It'll give you instant liquidity. Safety is great. The returns are very small. You can put a part of it in liquid mutual funds. They say that within 24 hours you can access it. The safety is very good. And then you can also put it in short-term FDs with auto renewable. So the goal is not to make money out of this. Okay, the goal should be that it should be easily accessible. Now, what you need to avoid is stocks, long-term FDs, equity mutual funds, real estate. These are investments. These are not your emergency reserves. Now, you layer it. You don't put all of the money. Say you've targeted 6 lakhs as your emergency fund. You don't put it in one savings account. First 1 month, you can put it in a savings account wherein it's accessible by a debit card or UPI. Part of it, 2 to 3 month account, you can put it in liquid funds. and then 2 to 4 months you can put it in short-term FDs. So you layer it in different channels. Now, so again 6 lakh, 1 lakh in saving account, 2 lakh in liquid funds, 3 lakh say in a short-term depth fund or a flexi uh, FD. So what happens is if you put it in a savings account, it's going to yield you very minuscule return of 2 to 3%. But if you put it in these liquid or FD, what happens is you get an extra 1.5 to 2% annually. So that adds up in the long term. The next thing is fixed income. So your emergency fund is that earmarked thing for say an emergency like COVID or a job loss. But you should also have something known as fixed incomes, wherein these are relatively predictable options for investment and they have fixed returns. So they have predictable returns, they preserve the capital, and it helps like a psychological anchor. You sleep better knowing that this part of your portfolio is stable. So what are the things which come under it? Government bonds, corporate bonds, municipal bonds, and fixed deposits. So you need to allocate a part of your portfolio in these things. Now, let's see how you'll go about it. You open a separate account, you put it only for emergency fund. You may consider no debit card access, no UPI access, so that say you want to pay for a fancy dress which has come out in the market, you won't be able to pay with this. The next thing is that you should earmark the amount, and the day you get your salary, put it in that a part of it, put it in the emergency fund. Also, if you start getting say some bonus or unexpected income, say a tax refund, put a part of it into the emergency fund. But do review your emergency fund. You may say that, okay, I've targeted 6 lakhs, but as your expenses increase with time, as life goes on, you may actually want to increase that emergency fund. So the other thing is that in terms of emergency fund and fixed income, there's also how much you should hold. So emergency fund, we kind of thought 6 months to 12 months expenses should be there. But with fixed income, what happens is that is kind of variable. So say you're a person with a low age, you're starting at say 30. Then you can have a larger equity exposure wherein you are taking more risk. You'll probably get higher returns, and lesser amount is in fixed income. While as age increases, your equity exposure can probably go down and your fixed income can increase. So the rule of thumb is equity percentage in your portfolio should be about 100 minus your age. So that's like a starting point. It's not a rigid law. Also, a person who's aggressive may want to put more in equity, while a person who's conservative might want to put more in fixed income. So that you'll have to decide for yourself. Also, if you have short-term goals for which you need money, you might want to put it in liquid funds, short-term debt funds, or FDs. For your long-term goals, you'll have to put it in equity so that there is growth. So fixed income allocation isn't a single number. It depends on your age, what are your goals, and how much is your risk appetite. There's also the thing about PPF or Public Provident Fund. Now we all know about it. It's a government-backed thing which has a 15-year long-term savings scheme. The interest rate is around 7 to 8%, and you can contribute maximum 1.5 lakh per year. And the amount you put in is exempt from taxation. It's a very safe thing. It's tax efficient. It's good for retirement. But it should be only a part of your retirement. It should not be the entire retirement fund. The problem is that there would be, say, a 15-year lock-in period. Partly, the returns may not beat inflation, which is a huge thing. So your capital would be preserved, but it won't beat inflation. And there's a cap of 1.5 lakh per year. So PPF comes in the central category, wherein your PPF is a part of your fixed income asset. One part, the third part is the emergency fund, and one part is your equity mutual fund. So PPF you can calculate amongst your fixed income asset. So, and it will be part of your retirement fund, not your complete retirement fund. Now let's look at the Indian context. What happens is in the Western and the developed country, the government has a safety net like the social security system. So in India, we don't have that. And your emergency fund can become your social security system. The problem is that 75% people have no emergency fund. 47% save less than 10% of their monthly income. No unemployment insurance like Western countries. And medical emergencies, especially with the rising cost of medical treatment, can wipe out decades of savings instantly. There are also challenges, like people think we can borrow from family, we can invest in real estate, but that can be completely, you won't get liquid cash when you require it. Also, buying gold for emergency, again, it may not give you that great returns when you want to sell it off. What's good is people are getting more financially aware. Young people are adopting the discipline of emergency fund, and liquid funds and FDs are very easy now to invest in using the online system. And because of COVID, people have become extremely aware that bad things happen, and you need to be ready. Now let's look at a few common mistakes. So first thing is investing in emergency fund. I'll put it in stocks. Now what happens? Well, I'll remove it from the stocks when I need money. Now what happens is, say you were in COVID, there was an emergency in the family. If you would have tried to remove money from that, you would have removed it at a very low value. So that money, that investment wouldn't have made sense at that time. You would lose money. Then you confuse my mutual fund is liquid enough. The emergency fund is not your investment portfolio. For different goals, you should have different instruments. The third thing is you undercalculate expenses. So you forget, say, an insurance premium, or say you might have some annual bills that you may have to pay. So you need to include those, but keep a 20% buffer for surprises. Then you can raid it for non-emergency. Say, oh, my friend is going out on a trip to Dubai. So I'll raid from my emergency fund, and we'll make it work. So emergency fund is meant for emergencies. It's not for silly things or extravagant expense. Now, the other thing is, we think, okay, say a 25-year-old doctor, I'll start saving once I earn more. But what happens, especially in a young age, if young doctors don't have a financial buffer of their family, it's more important that they save for an emergency fund. Say an older doctor may have certain other assets also. But for a younger doctor, it's very important that you start having that discipline right in the beginning. Then you put it everything in a savings account. Again, not great. Use the layered structure so that you make a little more from that 1.5 to 2%, and plus you have things, not all the eggs are in one basket. So then you have blind faith in FDs and gold. So they are safe and sufficient. That's not okay. Right now, they are high quality bonds, they are death funds, and you should have a balanced allocation. And for the last thing is that you put it money into random funds, into ULIPs. So you shouldn't do that. You should properly earmark, okay, this is my emergency fund, and you promise that you touch it only during real crisis. So in the 2008 crisis, what happened is that people who had emergency funds, they stayed calm. They bought assets at a cheap rate and then got a great, as the markets came up, the valuation increased. They recovered fast. They came out ahead. Well, those who did not have an emergency fund were forced to sell at the bottom prices. They took years to recover. So it buys you peace of mind. Your emergency fund, it's not exactly like a financial thing, but it's more like a psychological thing. That, say you are in a bad job, you can say no if you have an emergency fund. Or you're negotiating for a new job, you can probably negotiate for a better pay. Okay, even if I don't get it, I have the emergency fund backing me. Then you suddenly a bill comes up from somewhere and you're not panicking. You can help your family in crisis. You can be calm during market crashes. So it's a psychological dividend, and you sleep better, you think better, you make clearer decision. That's the real return on investment. So the certainty is a crisis will come. We just don't know when it's going to come. Markets will crash again. They always crash. unexpected expenses will hit you. They're known as unexpected for a reason. You have two choices. First, you just hope and pray that it doesn't happen to you. The spoiler is it will. The second option is you build your fortress right now while times are good. And that is the good logical choice. So today, now that you've probably understood that an emergency fund is required, calculate your numbers, say 3 months, 6 months, 12 months. Open a separate account or say a sub account this week only, not next week, not next month. And you automate and put whatever amount is required into that, or have a calculation that over the next 1 year or 2 years, I'm going to fill this much amount in the emergency fund. And start off with the decision and the implementation today itself, and your future self will thank you. So thank you for this opportunity. And with this, we can probably lead to Dr. Pasayanti to take her talk on mutual funds, and then we can have the panel discussion.
Sure,
Yes.
I'll share my screen. So, is my screen visible?
Ma'am, your
It is
screen is
visible.
visible. Yeah.
Yeah,
Huh.
okay.
Slideshow, yeah.
Thank you, Dr. Jayashree, for giving me this opportunity, and thank you, Voss, for having me here to speak on mutual funds and ETF. I was a part of WealthCon, a financial educational platform, and I was a financial illiterate before joining WealthCon, and I have gained all my knowledge from WealthCon, and we are all medical doctors and not SEBI registered financial advisors. So whatever I talk is the knowledge that I have got from WealthCon. So the investments that we have can be either active or passive. So when you have enough knowledge about the market and you know you have the time to track the market, then active investments are your choice. But when you do not have the time to track the market and you just want to make these funds to investments to remain in an autopilot mode where you don't need to think about them, then passive investments are definitely a good choice. So in the passive investments, we have two important types of investments where we can invest. These are the ETFs and the mutual funds. So how do they work? In the mutual funds, the money is pooled from a group of investors, and a fund manager would invest in stocks on behalf of us, and the returns that they get from the stocks would be shared to us, again to the investors. So this is how the mutual fund would work. And ETF is an investment company. It manages single portfolio of investments. That means if you do not, you want to invest in the top 50 companies and you do not want to track the market, then you can directly invest in Nifty Bs, which would track Nifty 50. So like that, there are stocks, bonds, real estate, and other assets which are being tracked by these ETFs, and thereby we can invest into ETF and get the benefit that we would get by investing into each of these stocks. And here the advantage in ETF is you can trade them in the like the stocks in the Zerodha platform. And so it is very transparent, and the prices do fluctuate throughout the market hours, and you can trade them. In the mutual funds, we have either debt mutual funds or the equity mutual funds. So in the debt mutual funds, they would invest in government security, corporate bonds, treasury bills, and debentures. And in equity mutual funds, they would invest in stocks. So why do we need to invest in mutual funds? So because we have the professional expertise of the fund manager who is investing on our behalf. And also we can diversify. Even if we are having good knowledge and we are investing in stocks, we are diversifying our portfolio so that we are investing passively some amount in the mutual funds. And the returns definitely are better than the fixed deposits or any other passive kind of investments that we do. And the tax benefits are also better when compared to fixed deposits. So considering the broader spectrum of the audience, I am just giving a few terminologies before we understand how to invest. So the new fund offer is a so these are the terminology from the mutual fund. New fund offer is the new mutual fund that is started, and it comes with its scheme, aims, and objectives and the style of management. So the newest, as soon as it gets released into the market, so this is the fund offer that it would release, showing what are the securities that it would invest into and what is the style and so on. The asset management company is the trust which runs the mutual fund. The asset under management is the total amount of money which is invested by a scheme. And the face value is the original price of a unit of the scheme at its launch. And expense ratio is the part of the fund's asset which is used for administrative and operating expenses. So this has to be low because this is a cost to us. So this expense ratio has to be low when we are investing in the mutual funds. Then systematic investment plan. So when you're investing a fixed amount at regular intervals in mutual fund, this is systematic investment plan, that the SIP that we call. The systematic withdrawal plan, where we can withdraw certain amount at predefined regular intervals. And net asset value is the share of the mutual fund. So the initially when it is released, it is the face value. And once every day, the asset management company would release the net asset value. That is, the stocks would grow. So, and also the number of investors that would invest into this asset management company will also grow. So it will change every day. So how do you get it? It is the value of the total number of securities held by the mutual funds divided by the total number of shares held by all the shareholders. So every day this net asset value will be released, and this is the value that we can redeem or purchase on that day. Then we have open-ended schemes where the units can be bought or sold anytime. And closed-ended scheme, there will be a lock-in period where you cannot buy or sell during that lock-in period. Entry load is the fee charged by the mutual fund when we enter the mutual fund. Exit load is the fee charged by the mutual fund when we exit the mutual fund. Now, there are certain components in the mutual fund that we need to understand. So there are different types of mutual funds: the equity, debt, hybrid, and solution based, and others. So the equity, we have the large cap, mid cap, small cap, flexi cap, and so on. And in debt, we have the overnight, liquid, ultra short duration, low duration. So these are the debt instruments. Then we have the hybrid funds, which would invest both in equity and debt. So based on the ratio in which equity and debt are there, so there are either aggressive, balanced, conservative, arbitrage funds, etc. Then there are solution-based mutual funds where, based on the goals that we want, we have the mutual funds, and we have the ETFs. Then the options that we have are the growth option. Here, whatever that we are investing, they will not give the dividends back, and it will be reinvested into the mutual fund again. Thereby, it will give us it will give us the advantage of the compounding. And in dividend reinvest option, the dividend will not be, the dividend again will be used to buy extra units of the scheme. And in dividend payout scheme or the income distribution capital withdrawals plan, here the dividend is given to the investor, and this is not really good because it loses the advantage of the compounding. And we have either direct plan or a regular plan. So the regular plan is sold by the distributor or an agent, in which they will receive the commission from the asset management company. So there is a distributor in between us and the asset management company. In the direct plan, we do not have any mediator involved. So we save the commission that we give to the distributor. And also we have, so this is the reason we have less expense ratio, and therefore we have better returns. So because of the low expense ratio and high rate of returns, and we also have higher NAVs that we get for the direct plan. So, for example, if you invest 50,000 per month over 30 years in a regular plan, which gives you a 14% return, the final value is around 22.7 crores. But the same amount when invested in direct plan, which gives you 1% more, because we save the commission. So there is a huge difference of around 5 crores at the end of 30 years. So the important takeaway is always choose growth plan, an open-ended scheme where you do not have any lock-in period, and a direct plan. And never invest in new fund offers and regular plans or the sectoral funds. Then coming to the types of the equity mutual funds, you have the large cap mutual funds where they invest into the large cap companies which have low risk, and they give us a steady wealth creation. but the risk is very low, but definitely they are the top companies, so the chances of them giving us good returns are well. Then in mid cap companies, they invest in the next mid cap companies. The risk is moderate, but they give better returns than the large cap companies. The small cap mutual funds would invest in small cap companies, but they have the highest risk, but they have the chances of also giving us highest returns when compared to the large cap or the mid cap. Then we have the debt mutual funds, which invest in treasury bills or in central government or state government issued bonds, and these have moderate returns. So this debt mutual fund is for us to park our excess money, and like for the not for the emergency fund, but for the next 1-2 years, we need some liquid cash. I mean, and we do not want to have the money lying down in your savings account and have decent interest which would be coming, and then you can park them in the debt mutual funds. Then we have the hybrid mutual funds, where depending upon the ratio of the debt and equity, we have the conservative fund where you have more of debt compared to the equity, and balanced one, both of them are almost equal, and in aggressive fund you have more of equity and less of debt. So how do we select mutual funds? So our founder of WealthCon, Dr. Ramnath sir, has proposed a criteria called CARISA criteria, so to select the mutual funds. So the first CAA is the eliminating criteria. So the category of the fund is in equity, we select either the large cap, small cap, mid cap, or the flexi cap. And in depth, you either select the liquid funds, gilt funds, or ultra short funds. The age of the asset management company has to be at least more than 5 years, and asset under management has to be more than 500 crores, and never. So this will help us to eliminate newer funds and also smaller funds which have low asset under management. Then RESA is the selection criteria. So here we should see that the expense ratio has to be less. It has to be less than 1, and it should never be more than 2. The Sortino ratio and alpha ratio, these are the risk determinants which we will discuss in our further slides. So these are the risk determinants of the mutual fund. So these have to be more than 1. And the returns, different types of returns, the point-to-point return, the SIP return, trailing return, and rolling return. So these we have to check. And then never invest in expensive funds which have high expense ratios and the risky funds. And these risky funds we can screen out by seeing the Sortino and the alpha ratio. So this is the CARISA criteria designed by Ramnath sir. So what are this point-to-point return? So when you want to see the return from one point to the other, so like from here, from 1st July of, so today it is 28th July 2026. So I want to see the return from 2020, how it has been faring. So you give a date from there to now. If you see the return, that is the point-to-point return. Then there is also one more return, the trailing return. So this is almost like a CAGR. So you will be able to see, so on 28th July, it will compare how much return I would have got if I had invested the amount on 28th July of 2025. So over which the trailing return would be given. And then rolling return is the average of the return over multiple overlapping periods. Like it compares the return between 2011 to 16, 2012 to 17, like that, over multiple overlapping periods. The returns are being averaged, and therefore it smooths out the market timing bias and measures the consistency of the performance. So all these returns have to be checked when we are trying to invest in the mutual funds. Then the Sortino ratio. So this is the risk determinant. So it measures the risk adjusted return. So Sortino ratio, the formula is the expected return minus the risk-free return divided by the standard deviation of the negative asset return. So this will help. This has to be more than 1. So the negative side we are eliminating so that the risk is less, and therefore this has to be more than 1. Then alpha is the excess return that we get compared to the benchmark index. And an alpha of 1 means the fund has outperformed its benchmark index by 1%. So this has to be more than 1. Now, what to buy after seeing the CARISA criteria? What to buy? So if your goal is wealth creation, so yeah, that means long term, and at least long term in the sense that it has to be at least more than 7 years, and you are you want to accept the risk because you know the market just can crash, as we have seen in our previous speakers presentation, and you are young. then it is better to invest in equity mutual funds. And when you want to protect your wealth and it is only for a short-term goal that you want and you do not want to take much risk, and if you're more than 60 years, then it is better to invest in debt mutual fund. And how many mutual funds should you have in your portfolio? It should be less than a dozen. So you can have one or two of large cap, mid cap of one or two, small cap of two, a flexi cap of one or two, and hybrid and gold. So how do you select? So there is a website. This is the valueresearchonline.com. When you go to this website, you can see there is an option of fund screener. And when you go to this fund screener, you can see the various equity, mid cap and small cap equity, debt and everything, and large cap, mid cap, you can see. So here you select the fund house and fund category and select the equity large cap. And you choose the open-ended schemes and direct plans. And also you can exclude plans which are suspended for sales. And you select active management style, because this active management style, the fund manager would actively churn the securities that are invested. And once you do that, see, we had around 170 mutual funds before, and now it has, after applying the filters, it has come to around 34 funds. Then here we have the calculate point-to-point return. So you calculate the return, because I would want to include the COVID period also. So I am starting from 1st Jan 2019 to present date. So once I apply, the point-to-point returns of various large cap mutual funds would come. I would arrange this in a descending order to see what are the funds which are faring well. You can have fund 1 to 10. You can write it over a paper, or you can export this to an Excel. And here we can see Invesco, Nippon, and Canara and Baroda. These are doing well. And then you again see the returns. Here in the returns, you see the SIP returns. So once you click the SIP returns, the 5-year SIP returns, again you arrange it in descending order and see which are pairing well. Here again, I can see the Invesco and Nippon and Bandhan. And then you see the long-term returns, and this also you can see the 5-year returns and arrange in the descending order and see what all funds are faring well. And I'm sorry, you also can see the like age and expense ratio. So in the when you're seeing the point-to-point returns, you can see the age of the fund. It has to be more than 5 years, and the asset under management has to be more than 500 crores, and expense ratio has to be less than 1. So after seeing SIP return, long-term return, 5-year return, and then you see the risk. So here, when you're seeing the risk, you see the Sortino ratio. And again, arrange it in the descending order. And you would see that, so what are funds are having a good Sortino ratios. Again, Invesco, Nippon can be seen in the top 5. And Alpha also, you arrange in descending order. You would see these various funds. It has to be more than 1. So once you zero down to 2 or 3 mutual funds, then you see for rolling returns. So rolling returns, you go to another website, the primeinvestor.com, where you can calculate the rolling returns. I mean, you can compare the rolling returns of all the 3 mutual funds that you have selected here. So you select the equity large cap fund and I have selected Nippon, Invesco and Bandhan here. And I have compared the rolling returns over the 5 years. So here it is showing that Nippon is giving an average of 14% and Invesco is giving around 14.99%. The maximum that they have given and the minimum that they have given and the standard deviation. So this standard deviation has to be less. And the people who have got more than 20% return is around 12% in Invesco and 9% in Nippon, and it's 7%. So based on this, you can take a call which mutual fund you would want to invest in. So once you have understood which mutual fund you want to invest in, then where to buy. So you have various websites, the MF Utility, Kuvera, Zerodha Coin, and respective AMC portal also you can purchase the mutual fund. So this is Zerodha Coin. So here you go to the coin and you can select whatever large cap fund or mid cap fund that you want to select. And you can see the current NAV, it would give you the CAGR, what is the minimum investment that you have to do, and the expense ratio it is also giving. Then you can just put it and you can click buy and also have an SIP mode, so that you do not need to do it every month, and it will automatically get deducted every month. Then coming to exchange traded funds. So this is the type of security, as we have discussed, to track an index, sector, commodity, or any other asset. So it can be purchased or sold on a stock exchange like a regular stock, and it is created by the AMC floating the fund. So these are considered to be the passively managed funds, as we do not have the portfolio managers. So we do not have the fund managers. So what will be less? So we do not have the expense ratio here, and it will not try to overperform the benchmark index, but it will try to mirror the index that it is tracking. So there are various types of ETFs, the equity ETFs, the Nifty Bs, which would track the top 50, the junior Bs, the next 50, and then we have the mid 150 Bs, the bank Bs, and we have liquid Bs, and commodity ETFs like gold Bs and silver Bs, and so on. So these are the various types of exchange traded funds that you can have. The MON 100 would track the US market also. So these are the various ETFs that you can buy. So these are managed with a Nippon AMC, and 1 unit of the B is approximately 1% of the underlying index. So how do you see for which ETFs that you would want to take? So here you can see in the NSE India website, you go to the exchange traded funds and see for the liquidity. So for that, you check the volume and the value that it is traded at. So the value, again, you arrange in descending order and see which are having higher value and which ETFs are having higher volume. You arrange it in descending order and see. So so then you can buy them in the Zerodha directly. So then you go to the Zerodha. So this is the Zerodha Kite website, and you can just click on Nifty Bs, Gold Bs, or Silver Bs. You just want to have an SIP, you can just click them. So this is how the screen would appear. You can have an SIP mode. You would want to have a fixed amount to be going to this kind of ETFs every month, then you can just set it under autopilot. So this is the ETF basket that I have created, and this has been active since a long time. So this is an autopilot mode. So you do not need to see every month, and you do not need to put in your mind every day. So the take home message, in case of mutual funds, always take direct plans, growth plans, and apply CARESA criteria when you're selecting the mutual funds. And you do not need lots of mutual funds, just 10 to 12 mutual funds are enough. And have an autopilot mode for all these things to have a passive investment going on when you are working. And ETF is a very good way where you can invest, and you can happily invest in the Zerodha website directly. Thank you.
That was a wonderful presentation, Dr.
Thank
Parshanti. It has like covered everything about mutual fund. You have like nicely covered from the basic aspects to what all things that has to be looked into. And now it is open for discussion. Both the topics are open for discussion. Mm. First of all, any comments that the panelists would like to give? Dr. Thomas, sir?
Yeah, one comment I would like to give is when we're talking about emergency fund, we were talking about a savings account and FDs. But what I have personally done is I got two bank accounts in two different banks. One is connected to my Demat account, and that is my expense account for regular expenses. The other one is where I go for as an emergency account, and I've managed to keep 1 year's worth of salary there as such, but not an SB, but with flexi FDs. So there's a SB account, savings account with maximum of 50,000 sitting there, and everything else that is there in the emergency fund is as flexi account. So I don't have to actively withdraw. I just need to withdraw with a check and it comes back. So that helps. Automation, basically.
Auto sweep, no, sir?
Yes, that's right. That helps as a automation there also. I fall sick, I can write out a check and give it to the doctor concerned or the hospital concerned, and it'll come back. I don't have to go and withdraw the FD or go on the net and withdraw the FD even.
And another aspect of this emergency fund, what I have done is I have this overdraft account for home loan. So whatever extra income comes, whatever extra salary, extra amount comes, I fill in my home loan. So since it is an overdraft account, it reduces my interest for the home loan, and whatever extra amount that I have filled in is anytime withdrawable. So I
You
don't have
brought
to
up an absolutely clear point. That is, if you have a loan, pay it off fast. That's as good as actually starting your savings.
So that
Because
loan,
your loans eat into whatever you can save. So having a credit card loan or a personal loan is the worst thing that you can have. Pay off any loans that is there with you. It's all eating into your savings.
so actually I don't have some this 6 months or that kind of emergency fund separately, but I have that kind of money saved in this overdraft account.
So I'd like to open it to all the panelists. Say you have earmarked, say, 10 lakhs as your emergency fund. How would you park it into different, say, different baskets? So anybody would like to comment or anything else regarding the emergency funds?
I would like to add, so in case of emergency fund, I would probably have uh, very little amount, not the 6 months expense, probably 1 or 2 months expense in my savings account so that I can withdraw it even in the middle of the night. But what I have been doing is I have been pumping the extra money into the liquid case. So liquid Bs or liquid Ks in the Zerodha. So that acts as an emergency fund for me, and in case of withdrawal, definitely it will take 2 to 3 days for the money that I can withdraw to. So 6 months of expenses I would keep there, but for immediate midnight emergencies, 1 or 2 months of your salary should be there in your savings account.
True.
Hello. Yeah.
Yeah.
Actually, whatever emergency fund I have, we have made FDs of smaller amounts, because it is better not, if you have a 5 lakh rupee FD, then you can't break it at one go. So I have made FDs of 1 lakh each, so that in case of need, you can break just one and then withdraw money. And now they are saying that for senior citizens, they are going to give insurance for 5 lakhs. At present, it is for 5 lakhs, and now they are going to give for all the amount. But that's why I've made my FDs of in two different banks, so that they both are insured. That is a 10 lakh amount.
So regarding this FD, the great idea, if at all it has to be FD, it has to be split FDs. That
Yeah,
is
split FDs. Yeah.
so it matures every month or every 15 days type of maturity. If it has, then it is absolutely, I mean, if you have 10 lakhs, it can be 2 lakhs or 1 lakh each. And the
Yes.
most important thing is like what Madam has brought about, the insurance of the FD. That 5 lakhs, if you put as to FD, it does not again have insurance if it is in the same bank. It has to
Yes.
be in two different banks to get that insurance coverage. And 5 lakhs is with interest. After the interest, if it is 5 lakhs, I mean, it is inclusive of the interest. If you put 4 lakhs something, that becomes 5 lakh with interest, that amount is covered.
Yes.
So if
Can
we
I just
have,
underline it? That is, it is a bank insurance is for a customer ID. So everything you have there is what is insured for that 5 lakhs. This is something that people don't realize. You park everything there, and suppose SBI collapses, I think India will collapse. Some bank that's big like that.
Can I say something?
Please, madam.
About this emergency fund, I use a credit card with a decent limit. I would say 5 to 10 lakhs as an immediate medical emergency or some such thing. Apart from having something in your savings account and flexi FDs, as Dr. Thomas said, the auto sweep ones. And those auto sweep ones, at least I keep them on a long term, not thoda time के लिए नहीं, but on a long term this thing. So if I don't need the emergency fund, it keeps on getting a little more interest. But if I need, then it comes in without a hitch. I don't, as you said, I don't have to go and cash it or anything like that. But I see that I'm a little older than many of you here, and I do have more FDs. I do keep more FDs. In fact, I'm trying to reduce that now, realizing that it costs me a lot of interest, a lot of tax.
Ma'am, I totally agree with this point about the credit card limit. So you can have a couple of credit cards with a limit of around 4 lakh, 5 lakh each. So here, what basically you're doing is you're blocking your money, not investing it, putting it as an emergency fund. And there you are having free credit, which you can always use in case of emergency.
Yes.
Plus, you are investing your corpus in the equity or wherever you are investing. So both ways you are on the winning side. You have a fund, you're not blocking your money to create a
I think that is the point. Yeah.
The most important point when you use a credit card is whatever amount you have with you ready to be encashed, that much amount only should be dispersed from the credit card.
Yeah.
Because you just get a
Yeah.
time benefit.
You should only use as much as you can pay at the next due date. Absolutely, I agree with that. And that's what the flexi FD and the savings account limit is for.
So,
And
on the
please.
topic of mutual funds, if one of the panelists can take it, there's a lot of talk about mutual funds, and even through our channel, we propagate that you should invest in mutual funds. But when should you, like, which are the mutual funds you should not invest in? Say a fund has given good returns for 3 years. You see the return value only for 3 years and it's good. What will be the things to look at? Okay, these things would be the red flags that don't invest in this. Like say in LASIK, we look at the red flags, no? So for a good mutual fund, like what will be the red flags when you won't invest in it? So anybody wants to take it up?
So I think Dr. Pashanti ma'am has actually covered it. I had also attended Wealth Clone class actually. So from that only that CARESA criteria comes into account. So before selecting any mutual fund, first go for these 5 criteria: the age, the AUM, and then this expense ratio, Sortino ratio, and then the alpha. So we just don't see the returns. It might have given good returns in the past, but from the time you are going to invest in it, it may not give that much return. So you just try to understand how the AUM, how much is their assets under management. It should be greater than 500 crores. If it is less than that, please don't invest, because you are a first time investor. You also don't have much experience regarding all these things. And age, you have to see, it has to be greater than 5 years. The expense ratio, as Madam was telling, initially you try to invest in only those mutual funds in which the expense ratio is less than 1%. And Sortino and alpha should be greater than 1%. Expense ratio has to be less than, the other two has to be greater than 1%. So this 5 things, if you look and start investing, you are actually investing in a safe mutual fund. You may not get that much high returns because you are not going to select high risky ones based on this criteria, but you will definitely get a decent return.
So my take on mutual fund that particular question that Dr. Shraddha asked, my first red flag of a previously ideal performing mutual fund would be, one thing is change of the fund manager. So if the fund manager has changed and the previously performing mutual fund is there, I will not take that mutual fund if the fund manager has changed, because it is fund manager linked. The performance is fund manager linked. And another disclaimer is, past performance of a mutual fund does not guarantee a future performance. So that has to be understood. These in small caps, if you have a large AUM, and even if you have as we can now say, like Parag Parikh has performed very ideally till these many days. That was because it had an exposure to international funds, and the AUM was not that high. But post-COVID, the AUM has been growing so drastically, and they are so concentrated type of fund to allocate funds into individual stocks. They are finding it probably little difficult also. So the equations keeps changing. You have to know the ideology behind that. Another thing that I always look is that whether they have their skin in the game. So Parag Parikh has that. So I mean, that's just an example, no financial interest. But these are the things I always look. Whatever said and done, if at all you don't know, you don't understand. I mean, as a beginner, I mean, my struggles as a beginner while understanding all these was like identifying or understanding the metrics. Sortino, alpha, all those metrics was little confusing initially, but to be frank, almost all of the over long term, over years together, most of the good performing, uh, this when you follow these criterias, most of these top 10 or top 5 mutual funds perform almost equally over long term. So you don't have to catch the best or go and find out the best, or do not stay away just because you don't understand or you cannot find out the best among that. And if at all you don't find out the best, you still have the index funds which will mimic the Nifty 50 or the like group of funds that of the class. So you don't have to pick and choose or identify any of the fund managers, or you don't have to put your brain into all those. Just believe in the growth story and invest your money there. The risk in Indian stock market at this point of time is not investing in it.
Yeah. Can I? Okay.
Yeah.
Please.
Uh,
Who is
I
speaking?
usually
Madam.
see in the Morningstar there is some website called Morningstar, which gives a chart of risk return chart. So return is plotted on the y-axis and risk on the x-axis. So when you put your mutual fund and if it goes on the upper left quadrant, then it is good to buy. So you can go and check your choice on the this Morningstar website also, which gives a very good risk return chart, which is a good benchmark to select the mutual fund.
Okay, ma'am.
Yeah, may I come in?
Yeah, Dr. Raj, please.
Yeah, so one thing, the question was that if a fund has performed in the last 3 years, looking at the past returns, would you invest? So one thing we always need to remember that markets are cyclical, and so would the funds that invest in the stocks, because these funds have invested in a particular set of stocks which have given the returns in the past 3 years. Now we can't expect that in the immediate next 1 year it will again give the same return. So maybe the fund is not bad, but it has already performed. So we need to always maintain one thing called as asset allocation. So whenever you are doing your investment, like if you are investing 100 rupees, always allocate it properly asset wise. Like if you are investing 80% in your equities, 20% gold, then in your equities, then make sure you are investing in large cap, mid cap, small cap, and across themes. So basically, there will be certain funds that are value investing, certain funds that are invest in growth funds or growth type of stocks, and certain funds which invest in momentum type of stocks. So basically, every time, whenever a cycle comes, either one of the theme will perform well. So now, for example, there were two funds which gave extreme returns during the last 3-4 years: Motilal Mid Cap Mutual Fund and Quant Small Cap. Everybody was talking about these two funds. But now, once they've performed, now their performance is on the lower side because obviously they've already performed. So always we should maintain a balance. So whenever something performs, rebalance it. Like for example, if I put it in X fund and it has become 3 times the value, I should sell off some fund and I should buy something which is at now available at a cheaper valuation. So that is called as timely rebalancing of the portfolio, maintaining the asset allocations. If you apply this strategy, then it's unlikely that you would go wrong.
And another thing, what Dr. Raj has told, asset allocation, most important thing. You have to do at least 6 months or 1 year. I mean, every 1 year, or when there is a market fluctuation that happens. But another thing that I also want to like highlight is that over distribution, over churning of portfolio is also something that you should not do, because that will lead to whatever losses are there are all just digital. or because when we materialize only the losses comes into picture and the taxation also comes into picture. So what usually it is seen that the amount of the amount of profit the mutual fund actually shows, that level of profit usually the investors do not get. That is because of the behavioral pattern. Whenever there is a dip in the market, what happens usually is that the investors you tend to stop the SIP because of fear and all those things. Hesitance, fear, whether this will again fall further. All those, if you are trying to bring your brain into this SIP pattern, then that is so simply it is like behavior plays a role in personal finance and our planning. So behavioral modification is very important when you're planning your finance.
But one thing we have to understand is when we are investing in any equity mutual fund, so you should just consider that this is long term. I mean, at least 7 years, you just forget about what you're investing, and because you keep on joining, once the it comes down and you just want to exit and do something, so it might increase the next year. So it is always better to keep the fund, I mean, stable till at least 7 years, and then or to at least 2 to 3 years, you just wait and then think about doing this journey.
And another thing is like you should also have an exit plan, especially with this equity, because like if you have like a plan, if you have starting investing today and you have like 2036 I will take it out, it should not be hard and fast 2036, because and maybe it is that time the market has fallen. So have a long runway for your equity investment and have an exit plan also, like 3 years in the time. So within 3 years, usually the market will show some rebound. So, Thomas, sir.
Yeah, I was planning to say what was already just said. That is, the stock markets have a 7-year cycle, all stock markets. So you're in it for a long term. And actually, your choosing of your funds should be when you're starting off. Once you bet on some 4 or 5 funds, trust them, trust the market, and hold on to it for at least 5 years, preferably 7 years, and you'll be surprised by how much you get. I can give you an example of myself. Way back in 2003, I bought Maruti shares, direct shares actually. And I was very happy in about 4 or 5 years when it was 10 times the amount I bought it for. And I sold it, and I've been regretting it ever since. Because now it's about 1,000 times the amount I sold it for. So you're in it for a long term, 7 years at least. Don't get spooked in between. In between, the markets will crash. You may find you're at a loss, but hold on to it for 7 years. You'll always be at a profit.
Dr. Neelam, before leaving, you have any comments?
No, I made the comment that occurred to me. This is indeed a great session, and I'm sorry I have to leave early, but all the best, and I'm going to be viewing all the sessions, whether live or by recording. This is an excellent show.
Thank you, madam. Thank you for joining.
Thank you for having me.
So one doubt I was having, like you said, we have to, once we select the plan and we start investing in it and we have put an SAP in it, we have been following that mutual fund for the past 3 years and we are not getting a desirable outcome from it. It is still very less than the FD returns. Should we still wait or should we sell it off and invest that amount in something else? Anybody?
Pashanti, would you like to take it?
I would say wait, because whatever I would invest into the equity, either it's stocks or into the mutual funds, I would just at least leave it, as Dr. George sir also had just said. So I just want to leave it because based on 2-3 years performance, I would not want to, because whatever we are investing into the stock market or into the equity mutual funds, we just have to think that this is a long-term investment and just have to leave, is what I believe.
If you have taken after
Correct.
proper assessment,
Correct.
and if that was
You
like
have to
truly,
wait.
strong, then you should wait. If it
Yeah,
was
because
just a random pick,
if you churn it out, it will attract taxation also. Because whatever 2% growth you have got, you will again have taxation on it. And if you have more of debt exposure, then it will be to your tax rate. And because if your uh, equity exposure is more than 65%, then only long term capital gain of 12.5% is applicable. Otherwise, it is going to be
20%.
according to your slab rate. So maybe 30% also. So unless you really want to get out of it, then only you do it. Because otherwise, a lot of tax burden will also come.
if you're like very not happy, you can at least pause for some time maybe, but don't withdraw.
Okay.
At least make it long
Raki,
term.
one
I'd like to
question,
come in
Raki.
once.
Okay.
Please.
See, basically,
Raki, one question.
if you don't have conviction on the fund, then it's a different story that the fund is not performing for some reasons. Other funds are performing in the same category, but this particular fund, like if you go for a mid cap fund, you are seeing all the funds are performing except for the fund that you have selected. Means that there is something wrong with that fund. But if overall the mid caps are not performing, then your fund is not performing. It's fine because you are seeing the last 3 year returns. Rather, I would say when the good times come, this is the time you will regret that अरे मैंने उस टाइम पे ले लिया होता तो I shouldn't have paused my SIP. That is the worst thing that you can do is stop or pause your SIP when the markets are at a lower level.
True.
Because you are not buying now at the cheap rate. It's like a sale. So अगर सेल में नहीं खरीदा है and then full भाव में खरीदना है तो then you will not gain profits. You should continue SIP unless it's the only fund that all funds in the same sector are performing, but your fund is not performing, then it's a different story. Otherwise, just continue SIP.
If your fund has a structural change that has happened, that is when you should look into it.
I
Sir,
have a
Thomas sir
question
was.
to Raki. I have a question to
Yeah.
Raki. You said it is giving you less than FD returns. Was it a lump sum investment you're talking about or an SIP? An
SIP.
SIP in anything with more than 500 crores, any mutual fund with more than 500 crores AUM will always stay ahead of an FD in present market terms in 3 years.
Maybe because of this recent crash, it is showing like that.
I will ask you personally which
Forget the
fund it
dips.
is.
Yeah.
Forget the dips. Forget the dips.
Sir, I would like to ask you, how is your asset allocation to the fixed income assets? Like, how are you investing in fixed income assets?
Me?
It's yes, sir. Yes.
Okay, I got a few bonds that are there, corporate and sovereign gold bond. So sovereign gold bond, by the way, is an interesting thing. You can buy it on the secondary market and you can buy it when the RBI gives it out. When the RBI gives it out, it's tax-free, your returns.
True.
When you buy on the secondary market, you attract capital gains. So that's so you have to watch out for it and buy sovereign gold bonds. G-Secs are there. A few AAA company bonds are there. And that's it. And then fixed income, I got my NPS going on, which will be an eventual fixed income. I mean, I made the mistake long back, but I have not stopped it. Pension plans and insurance companies were there. They're continuing. And I mean, since they're in their, what do you call, cooling period or whatever, post-premium, waiting for it to finish. And of course, I've got my flexi FDs. I don't have any other FDs, by the way.
Okay, sir. Thank you. Dr. Raj, how is your fixed income allocation? You're
Dr.
mute.
Raj, you're on mute.
You're still
Yeah, I'm audible now. Yeah.
Yeah.
It's a little on the lower side, fixed income. I invest in the equity side, but on the fixed income side, a little bit of emergency fund that I can have for a couple of months. Apart from that, PPF is where I invest because at least there I won't touch the money because I know it's locked in for 15 years at least, so I won't touch the money. So I don't invest much in this thing because it's basically age related. As more you near your retirement age, around 50, 60, you increase your debt allocation more. Your age is on my side, so I'm more on the equity side. So basic general rule 100 minus your age that you allocate as per your debt and equity. So as I go along, obviously I'll convert my equity investments to debt investment. But right now it's on the lower side.
Meenakshi madam, so your exposure, how is it?
Yeah, so now I am 70 years old, so I have more of these bonds. So I have senior citizen saving scheme. So that 30 lakhs I have put in monthly income scheme, and I have full PPF. I have not withdrawn it. I've continued it because the uh, whatever interest I have gets accumulated. You can go on tax-free interest, and you can go on extending it for five years. So I have done that, and I have some sovereign gold bonds, and those 10 lakh FDs. So that is my uh, asset allocation for fixed income.
Yes. So we just wanted to highlight like how the scenario changes, how the attitude of asset allocation changes over age. So that
Yes.
is also important. It also depends upon your risk as a risk taking
Yeah,
attitude
I have a
also.
lot of exposure to equity and mutual fund also.
True.
Big portfolio which we manage ourselves. Yeah.
I am aware, madam. But generally, what I am
Yeah.
saying is like
Yeah, but we have to have some fixed asset now that the age is catching up. So, and I have some rental income also.
Very important to have passive income coming to
Yes,
you.
yes.
So while
Yeah.
we are in this discussion, say we've learned about the importance of mutual funds and emergency funds. Say I was going to say that say a 25-year-old doctor or a 30-year-old doctor wants to start off with, then I realize that there'll be 40-year-olds, 50-year-olds also who want to start investing in mutual funds. Um, uh, I just add. Just going to say a few pointers. Don't worry about the jargon. Okay, start off. You can go to Value Research online, pick up a simple index fund, see the ratings which are already given in Value Research online website. If you have a little more interest, you may take the paid version, which is also very good and helps you just analyze even more in depth, or just if you don't want have time or energy or the bandwidth to go for it, just go with their ratings and invest in index mutual funds for now as your long-term investment. Try to keep it direct investment. Direct meaning you are investing yourself. The other is regular, wherein the agent comes into picture, and you will give say 1% every year to that agent on your returns, which in 1 year, 2 years it won't matter, but over long term, it will have a big impact on your entire portfolio. So the point is that don't get too overwhelmed by the jargon. The index mutual funds will follow the Nifty index. A part of your portfolio you can put in debt mutual funds, and now because of the online investing system, it's not difficult to figure out how to invest in it. The websites are pretty clear and very simple to do it. On this note, I would like other people to add, just how to ease out to our viewers that you can do it. It's not that difficult. Small things that you can add up to make your whole portfolio at over time better.
So more easier is also investing in ETFs. So you just enter Zerodha, and instead of having an index mutual fund, you can directly invest via an ETF, which will have a less expense ratio. So it is definitely easier. You just have to click Nifty Bs or Gold Bs or whatever that you want to buy, and just put an SIP. That is very easy, and definitely that will over a period of time, it will definitely give a good return.
Another small point is that just to start a mutual fund, you don't even have to have a demat account. Zerodha, ETF and all, you have to have a demat account.
I think one thing we forgot is always save first and then spend. So we just need to decide we're getting 100 rupees. we're going to save 30 rupees. I mean, ideal is 40% of your take-home salary post-tax. I mean, you're going to save 30 rupees out of that. So you save that and work on living off the 70 that's left.
True, sir.
That's the only way to go. If you say, I'll save what is left over, there will be nothing left over. Because we all know how to upgrade our lives easily.
As sir told, lifestyle inflation will eat all the money. Actually, wealth is money not spent.
Dr. Raj Shah, just one additional question. Say you went through a COVID crisis during, say, probably the beginning of private practice or midway into private practice. At that point, did you feel that your emergency fund allocation should be more than, say, 6 months, because there would be additional expenses of rents, of EMIs, staff salary?
So basically, I was lucky enough that I was about to start and the COVID got hit. So I had not made all the machines. I was in the process of buying all and checking it out, but I had not actually booked the machines and all. So luckily, touch wood, I didn't have to face the situation where I had already made the purchase and the EMIs were pending and all during that time. So yeah, definitely emergency funds do have a role in all this, but that was a situation that everybody understood. Nobody was on your head like any payment to karna padega, because they also knew that the situation is such that these things will get deferred for a period of 6 months to a year or so.
Right. So, but anybody into private practice, your emergency fund, the allotment you should or freelancing should be more than probably a salaried person. So just keep that point in mind. So, Dr. Meenakshi ma'am, the same question to you. Like you run your laser center. So, in terms of that, how would you account for the emergency funds for running that center, say an untoward incident there
Yeah,
or
in
some
COVID
litigation?
time, we had tough time because that time for almost 1 year, all the refractive surgeries were closed.
Hmm.
So we were using we had stopped our salaries. We asked the staff also to take less salary, and we had to close down the machines and everything. But we were doing some emergency work, and somehow we could tide over the crisis. And we had some amount of liquid cash, but there were lots of loan. So we deferred the loan payments, and then we requested, and AIOS also helped us, because company like Zeiss and all, the outgo for our annual maintenance was around 7 lakhs for 6 months. So that was waived off, which was a great help to us. Otherwise it would have been very difficult to tide over the crisis. But we could manage quite well with the emergency fund which we had.
Right. So,
And now we do, because it's a private limited company. So now I have a demat account once our loan is over now. And we do investments so that to keep ourselves financially healthy now. So we have learned from the COVID time.
excellent point, ma'am. So, moving on in another direction, if all the panelists could probably say one or two, the key psychological, principles of, say, personal finance that has helped you. It could be for a youngster, say, start early, even if you are not earning enough, start early. Of, say, for a seasoned professional like Dr. George, Dr. Meenakshi ma'am, that discipline was the key, saving even when there wasn't a goal. So if you all had to, come up with like one behavioral or psychological thing uh, for the audience. So, Dr. Pasayanti, you want to start?
So I would say you you have an Excel sheet of everyday expenses that you're having every month, so that you understand how much you are spending and how much you will be able to save. And first thing, as Sir has already said, first you save and then spend. So 25 to 30% you definitely have to save, and then you start spending rest of the amount. In case even if you are left over, you every day manage your expenses like you manage your budget. So every month you maintain an Excel. Over 6 months you would understand how much you would be able to allocate your investments into different baskets.
Easier now with the apps also available.
Correct.
So if you explore some of them, it would be easier. So anybody else wants to continue?
My
Never.
take is like, okay, please,
No,
madam.
no, go ahead, go ahead.
My take is like personal finance is not a choice. It is a life skill that everybody should have. With this digital platform now, everything is at your fingertips. My basic logic is like if I can do, everybody can do. Because when this COVID struck, I was a person who did not even have an insurance. But from there, I slowly graduated to this level where I can understand something about finance. And then I have taken it up like I have to educate people because this is such a boon that every day I regret not starting early. So let others start early is my motto. So that's it. Madam, how about you?
Yeah. No, I just feel that you should not increase your standard of living unnecessarily. You should not go by the whatever your neighbors are doing, or whatever somebody is buying a Mercedes, somebody is going overseas. You should do whatever is within your limits and whatever is your bucket list. But you should not go overboard because the market is doing well, so I will go for a world tour. You shouldn't do like that, because when the markets crash, you can't do anything else. So if you get money also, you should just continue your normal lifestyle, and continue saving, and be very regular about how you spend, and very careful about your spending.
Extremely important point, ma'am. Now with the social media and the
Yes.
comparison which subconsciously comes in our minds, very important to keep that in mind. So, Dr. Rakhi, I think you're waiting to say something.
No, I was just going to say because of the social media and Instagram and all, you're impulsively buying these things. So now I have also learned to keep the record. So once I kept the record of online shopping, which I had done for the past 1 or 2 months, I understood how much I was spending unnecessarily for things which are already there with me. Then now I have stopped. So now I see when I see a ad, I will just scroll it off because I know my limit is only this much. I have to do only this much. I think everybody should first make an Excel and try to write how much you have bought online. Then you will realize and then you'll stop yourself from doing that.
When you do
Can I add something to the online?
Yes,
This is
please, sir.
something I came across, I think, about 6 months ago. It was, I forget whose quote it is. You see something and you want something online, order it only 24 hours later. Quite often, you don't feel like ordering it 24 hours later.
Yeah,
Correct.
You
You
put it
don't
in a
even
wish
remember.
list, order 24 hours later. Make that a rule.
good idea.
Right. So delayed gratification is one of the key things while, trying to save and create wealth. So, Dr. George, I will not take that as your comment. You have to think of one more before you come up with one more. Dr. Radsha has something to say. Raj, you muted yourself. You'll have to say something.
About
One key message for the viewers.
so basically start investing if you are not investing. That's the first thing. If you feel it's too complex, then you might take help of a certified financial planner, though it will cut out your 1%, but rather than not investing where you are investing in FDs and earning 7, you learn at least 13, 14, 12%. That's over and above, much over and above what you are investing right now. So first try it yourself. If you feel it's too complicated, go through a certified financial planner, learn it. It'll take 2-3 years. It'll give you experience. Small amounts also you can invest. But once you learn it, then you can directly go to the direct platforms like Zerodha and other platforms and invest by yourself. But not investing is not a choice. So start investing and learn. So it's a series. Everybody is learning.
Right. So start early. Yesterday was the best day to start. But if you've not invested yesterday, today is a good day. Start today. So, Dr. George.
Okay. Two things. One is the power of compounding is one of the wonders of the world. Those who understand it earn from it. Those who do not actually pay for it. So there is one statement which is attributed to Einstein, but actually he's never said it. It's a statement that's been flying around only from the 80s, and he was not wrong. Other thing is, whatever you do in investment, automate it. You should not be sitting there and picking it every day and moving things around like chess pieces on a board. Automate it. And once you start it, even if you forget, it should keep continuing as you go along. I rarely look at my investments. I've been holding a Demat account from 2004, and I look at it maybe once in 6 months now, because I have seen it grow and I don't feel like selling anything. I just hold on to the mutual funds, and when I need it, I look around and decide which one I am going to sell. So automation is the key. SIP, SWP, whatever, automate it.
Right.
So, yeah.
Can I make a point? Yeah. So, and now lots of mutual funds are also having overseas exposure. So people can start looking at Motilal Oswal Nasdaq 100 ETF or Mirai Asset FANG, so that we can all invest in foreign overseas equities also. So that is also one more avenue now.
Yeah, that's a thing that I think everybody should consider, that giving some time to it, learning about it, and seeing
Yes.
which
It's a new thing which is
suits you.
there, so we can all try it. There are lots of platforms on which you can invest in the overseas market now.
Yeah.
Investing in overseas market may not be that, I mean, at this point may not be that straightforward. So that is the reason probably it is not covered at that length,
Yes.
because there is a capping and all, that 7 billion capping, and it has to get opened up. And the ETF, the issue is like it could be falsely elevated values also. And we have other options like other platforms which directly invest, and then the Gift City is coming. I mean,
Gift
the Gift
City has
City
come. That's what
funds
Gift
are
City
there.
is there.
So, but it is just started the maturity. I mean, it is in the maturing phase. So, probably we will have some exposure. I mean, some talk regarding all those in the
Later
coming
on.
sessions. And like probably it's time to conclude. Another just one sentence before concluding that I will tell is that to next sessions it will be on insurance and smart investing regarding like I mean, how as Dr. Pashindi has shown on mutual fund investing, we'll also show on the Demat investing. So regarding insurance, why you should be doing insurance, the main thing, important thing, as as Mr. Nitin Kamath has told, you are just one hospitalization away from bankruptcy. Also for this doctor community, we are also one medical legal case away from bankruptcy. So we need more insurances. So let's all be prepared, be wealth literates, and that's it.
Yes. Thank you. Very nice session, Jayashree. Very nice.
Thank
Yeah.
you.
Thank you all for joining.
Thank you all for
Nice
joining.
presentations.
Good session.
Thank
Yeah.
you.
Please do
Thank
join
you.
for the
Good night.
subsequent sessions also.
Yes.
Encourage us,
Thank
support
you.